Okay, so we've put the question on the page. You can look at it there. It's available on the page. Okay. We are back live on YouTube now. So we've put the question on the page. You can look at it. Okay. Yeah, Oxbeth, your hand is up.
Yeah, sure. Good evening.
Yeah, good evening.
Yes. So please, I want to find out what happens to an adjusting event after reporting date which passed the period of first quarter of the year. I'm talking of IAS 10.
IAS 10, events after the reporting period.
Yes.
Okay, you said an adjusting event, that's what?
What happens to an adjusting event after reporting date which passed the period of first quarter of the year?
The issue about adjusting events or IAS 10 generally is that you are going to be looking at whether the event has a relationship with something existing at the reporting date or not. If it has a relationship with something existing at the reporting date, then it becomes an adjusting event. Then if it has no, which means the financial statement must be amended. But if it has no relationship with a balance or an event existing at the reporting date, then it becomes non-adjusting event. And so we disclose it in the notes. However, there are certain non-adjusting events that can become adjusting if they affect the going concern of the entity. For instance, fire outbreak in the company's factory after the year end is naturally a non-adjusting event. But then if it happens that the entity has no insurance policy and the entity cannot have funding to rebuild the new factory, then it is likely that their going concern may be what? Affected. For that reason, even though it's a non-adjusting event, because the going concern of the entity is likely to be affected, it becomes what? An adjusting event. So that is the issue about that. Is that what you wanted to find out?
Yeah, so yeah, I have that idea, but what was my challenge is that after reporting date, you know, there's always grace period. They'll give you about the first quarter for it to be adjusted, isn't it?
It's not about grace period. It's about when our financial statement authorized. As far as the financial statement is not authorized yet, if the event happens and is adjusting, we have to amend the financial statement. Even if subsequently, after authorizing the financial statement, something happens that relates to previous financial statement, then it becomes prior period errors. And the IAS 8, then we would have to amend the prior period balances that will reflect in the new financial statements. So it is as from the year end to the time the financial statement is authorized. Everything that happens during that time, if it is adjusting event, it must be reflected in the financial statements.
Yes, so that is why I'm saying that you have identified an event which you are supposed to do the adjustment, but for some reason you have not been able to do it even after the first quarter of the year, which was you have been mandated to publish the financial results. But that same event is still not adjusted even after the 3 months.
So what is the basis of the concern now?
So what I am saying is that in case even after the first quarter you are still not able to adjust it, what happens then?
I don't know why the entity will not be able to adjust after they've identified an event that is an adjusting event. If they are not able to adjust, then the financial statement that is published will be faithfully not presented well. And that is against the fundamental code of ethics of integrity, because then the financial statement is going to be misleading to the users of the financial statement, which is not something we would want for our organization or for our company. So I don't know what will prevent the company from not disclosing.
So please, what if it is an external case, which doesn't, I mean, they don't have control over such situation?
Like I said, I don't know what, as far as they are not able to present the financial statement, then it has to disclose in the note. If there is something that prevents them to amend the financial statement because they are waiting on something else, and the financial statement must be published anyway in its raw state, then disclosures must be made in the financial statement that this is the financial statement though, but pending this event, should it turn out to be A, then this will be the implication on profit. This will be the implication of net asset. So that disclosure would have to be made in the financial statements.
Okay, thanks. That's what I wanted to clarify. Thank you.
All right.
Okay, thanks.
George said calculation on the number of employees for IAS 19, employee benefit. We said that we look at the provision for employee benefits based on the number of employees that are available as at the reporting, or that we expect to be available by the end of the term for the employee benefit at the end of the day. So at the reporting date, if we are in X1, X2, or whatever the heck we are in at, we will just have to ask ourselves, how many employees will be there at the end of the vesting period, or us at the end of the vesting period. So please say the grammar. Which one is grammar? Okay, so we will just look at the number of employees we expect to be remaining as at the end of the reporting period. And that is where our focus is going to be. And if you remember the question we solved in class yesterday, you will realize that we look at, depending on the wording of the question, if the question says, oh, we expect this number to live throughout, then that will be the figure we use. But if the grammar is like, these people have left and we expect an additional or a further to be leaving, then we have to include both the people who have left and the people who we additionally expect to leave in exercising the issue about the number of employees that are available. So it's about the wording. So if he says, we expect this number of people to leave throughout, then our focus will be on that number. But if the question said, or the grammar said, this number of people have left and we expect an additional or a further number of people to be leaving, then that becomes the grammar we use, where we will include both the people who have left and the additional that is expected to be left. So these are the two broad statements. Number of people living throughout, or some people have left and we expect an additional or a further to be living. So if you are in number of people who we expect to live throughout, then that number of people we expect to live throughout becomes the basis for our judgment. But then if they say some people left and we expect an additional or a further, then we have to include both the people who left and the people who we expect to leave when making the decision about the number of employees remaining at the reporting date. I hope that makes sense in that case. George. I'm seeing some chat on YouTube. Ibrahim Kondewa said, hi, sir. Hello, Ibrahim. Imuran Mumuni said, good evening, sir. Good evening. We're looking at consolidated financial statements. So if there are any questions for me, or for those of you joining us on YouTube, you can put it in the chat for me. In that case, please, is it financial reporting class? It's a consolidated financial statements class. So it's both financial reporting and corporate reporting students on the call. So it's a mixture of students on the call. So console is in FR, it's in CR. So it's not FR class, it's not CR class. It is both classes actually coming together. All right, let me share my screen and then let's begin our discussion. Let's look at our first question for the day. So if there are any questions, you put it in the chat for me, or better still, you raise your hand and I'll bring you up as we continue with our discussion. Let me see. I think I have Moby here. Okay. So the first question we want to look at is polyester. And like I said, the purpose of this masterclass is to look at the basic principles in consolidation. So I'm going to be explaining using the question as a guinea pig to explain various things. My take for you is to make sure that you understand everything. And if there is anything that I explain that you don't understand, you make sure you raise your hand or you put it in the chat, then we recover that again, because this is going to be very important. It's a 20-mark question in the exam hall, and the free marks available is what you have to make sure you get at the end of the day. So let's go. Paul Esther. Those of you, I've posted a question on the page. You can see it and open it up. So Paul Esther, is that the name of our question? Yep, that's the name of our question. For those of you watching on YouTube, you can get access to the question by sending me a hi on Telegram. Subscribe to my Telegram channel. We will be sending the question through Telegram so that you can have access to it. Let's go. Enough of the talk. Let's go to the requirement. That's where we go always. Prepare the consolidated statement of profit or loss for the year ended 30th September 2013. That is always important to us. And then the statement of financial position. Right. So once we read the requirements of the question, we need to then find out what are the workings we need to do by default. So based on the requirements of the question, by default, the following workings will be done. Number one, I need to look at the workings relating to the issue about the group structure. Definitely. That's an easy marks there. I need to deal with issues about goodwill, because that'll be a huge part that the examiner will set a question on that I need to know about. I need to work for group retained earnings or the consolidated retained earnings. We need to work for non-controlling interest, definitely. Every consolidated question, 99.9% of the time, will have some intra-group situation coming in that I need to work out for. And then definitely with my OGs, net asset schedule, if you want to prepare that net asset schedule. But I'm going to present this in two ways. I'm going to do net asset schedule, then one without net asset schedule. So you see the way alternatively, you can calculate the post-acquisition profit or loss for the subsidiary at the end of the day. Because like I said in the individual classes, if you are dealing with the how do we call it? The profit or loss, there is no need for you to do asset as acquisition, asset at year end. There is a simple way you can calculate the profit for the year, and then you'll be able to get your answer. So I'm going to do the two so that you see how the treatment goes by. But please make sure you stay with me carefully. So let's go. Preamble. The preamble or the note one, there are some consolidated questions or consolidation questions where there is no preamble. In that case, note one becomes our main area that we have to start our journey with. But here, there's a preamble. So let's go through the preamble. On 1st April 2013, Polyester acquired 75% of the equity shares of South Star. Okay. That means I got my group structure situation coming up. So let's go. These are my workings. You don't have time reading all the question. So we bring in the group structure coming in. So Polyester, we get our South Star. They are acquiring 75%. So non-controlling interest is 25%. It's very important that we understand the date of acquisition for the question. So date of acquisition, that is 1st April 2013. Then our reporting date will come up 2013. Then our reporting date 30th September 2013. If you remember, that is our reporting date for the financial statement, 30th September 2013. So how long is that for the post-acquisition period? April, 6 months. Okay. So our post-acquisition period is 6 months. Let me take this guy up a little bit. So post-acquisition period, 6 months. Now, if the post-acquisition period is 6 months, it means that technically, when I come to the financial statement of South Star, when I come to their P&L, I'm going to take what? 6/12. Sounds good? They said I should prepare, or we should prepare P&L. So when it comes to the P&L account for South Star, we will take 6/12 for every figure we pick. 6/12. Why? Because the post-acquisition period is 6 months. Let's continue. South Star has been experiencing difficulty or difficult trading condition and making significant losses. Allowing for South Star difficulty, Polyester paid only 1.70 per share, which the directors of Polyester expect to lead to a bargain purchase and negative goodwill, which lead to a bargain purchase and negative goodwill. So what is that? That is basically the cash consideration. Yes, Martin.
I was asking, if it was a full year consolidation, then you that when you come to the performance, are you going to take the whole figures from the subsidiary?
If it is more than a year, then definitely we will take all their figures when we are consolidating.
Without taking into consideration of the percentage of the acquisition.
No. In the P&L account, we don't care about percentage. It's about the years we deal with, or the period of post-acquisition. So the percentage of acquisition doesn't come in at all. It's only when we are dealing with sharing of profits that the percentage we have acquired will be a factor we consider.
Okay, thank you, sir.
Right. So what we see there is our consideration coming up. And so they said the directors or Polyester paid only 1.70 per share, which the directors of Polyester expected to lead to a bargain purchase and negative goodwill. Okay, so if that is the case, then I go to my workings too. Now, it looks like in this question, I don't need to do a lot of miracles on fair value of consideration transferred. So I'm going to set this up, workings 2, as my goodwill. So I'm going to set up my goodwill in workings 2. And are we working 3 zeros up? Yep. So we slash in 3 zeros. And we bring fair value of consideration. So if you look at it, they acquired 75%. Let's go get a number of shares of Polyester. So you go to their capital statement of financial position. Let's see their equity. Now, be careful here. If you look at their statement of financial position, look at the shares. It's 50 cents shares. So they have $6,000 here. So we need to get a number of shares. So to get a number of shares, what do? We divide. Okay, so we go here, and I'm going to just work at that as my workings 3, because it will be part of my workings. So number of shares will be $6,000 over $0.5. That is 50 cents. That will be what? 12,000 shares. Sounds good? So the number of shares in this company is 12,000. So we can go back now and pick 75% of the 12,000 and multiply it by how much we paid to the business, 1.70. So let's multiply that up. 0.75 times 12,000 times 1.7. And that gives me an amount of 15,000 300. So that is our fair value of consideration transferred. Certainly, this is a cash consideration. So no miracle coming in this particular case. It's a cash consideration, 15,300. Yes, Martin.
Yeah, insurance that they say 15,000, which can be found in the not as investment in South Star.
Okay, we have not come there yet. We could look at that later on, but yes, definitely, that is the investment in South Star because that is what they pay. So that will be what will come there at the end of the day. So yes, that could be seen as the investment, but I would have come to that later on as I read my question.
Yeah. How about if you calculate this one and maybe the figure is different from this one, how are you going to treat
The
it?
word, then in that case, the preamble would just be investment. And then there will be a breakdown on the investment or just the word investment. Then the examiner will indicate the meaning of that investment. So that in that case, if the examiner gives us a breakdown of that investment in the notes, then let's say that one is 20,500. Then when you subtract the 15,300, whatever we get will be other investments that will be carried in the books as per IFRS 9 financial assets. So in that case, the breakdown will be given to us so that the balancing figure will become other investments and you carry it as a financial asset.
Okay, most grateful.
Right. Okay, so that is our fair value of consideration transferred. Let's continue to read as we build our knowledge. At the date of acquisition, the shares in South Star had a listed market price of 1.2 each. We don't know. Maybe we will use it later on. So we just read and jump over it. Below are the summarized statements. Sorry, below are the summarized draft financial statements of both companies. Now, you see, sometimes somebody will say, oh, if I have to do 6/12 of these figures, why don't I just go and extract the consolidated financial statement and start with it? Please, there is no need for that because you have to do workings for goodwill. You have to do workings for cost of sales. So again, jumping to go and do extraction, it is not needed. So that is why you read the notes, do your workings, extract the financial statement later on. So let's go to the additional information and let's see what is going on. At the date of acquisition, the fair values of South Star's net assets were equal to their carrying amounts, with the exception of a leased property. This had a fair value of 2 million above its carrying amount. 2 million above its carrying amount. So it means they have understated their assets. So we need to what? Bring it up. Now, I told you we can do two presentation if we want to present ourselves at the end of the day. So I could go to my workings as per my workings here, bring in my net asset schedule. If I want to. And then we have at the reporting date, then at acquisition, then we have the movement in the final column, working 3 zeros up, respectively. Then we bring in the share capital. If you remember the share capital of our company, it's 6,000. I think we use the figure somewhere here, 6,000. So same at reporting, same at acquisition, dash it up. Then you look at their retained earnings. Please stay with me carefully. The retained earnings here at the reporting date is 12,000. $12,000 at the reporting date. Chances are it will be the same at this at the date of acquisition, but we don't know. So the question we ask ourselves is, how do we get the retained earnings at the date of acquisition? Like I said, we're going to be doing 2 presentations of how this whole thing is supposed to be at the end of the day. Now, so if you look at it, let me go back to my question. For the year, our company made a loss of 4,600. Now, we don't know if they paid any dividend. So for now, we will not read the question, or we cannot conclude on anything. So the retained earning at the date of acquisition, I'm going to leave that place blank for now, because we have finished reading the question, then we build consensus relating to what we have to do there. So for now, I'm going to leave that at 12,000, and I'm going to explain that to you in a moment. So their retained earnings, it's coming there, 12,000. Then we bring in the fair value adjustment, which is the language we just read a moment ago. That says there is a leased plant, has a fair value of 2 million above. So we bring it up, leased property rather. Above means they have understated. So we add, so the same figure will be at acquisition, the same figure will be at the reporting date. Then they said this had a and the remaining lease term of 10 years at the date of acquisition. A remaining lease term of 10 years at the date of acquisition. So we bring this up, and the depreciation is supposed to be charged in cost of sales. So if we look at it carefully, you realize that we're going to bring depreciation here. And so that's going to be 2,000 over 10. But remember, our post-acquisition period is 6 months. So that's going to be 6 over 12. Okay, because from our group structure, our post-acquisition period is 6 months. So we work that out, 2,000 over 10 by 6 over 12, and that gives us 100. And that will be deducted at the reporting date, and that may go here as movement. Now remember, the net figure of this will go to PPE, and they said depreciation should be added to cost of sales. So right from here, there are a couple of workings I can proceed to do. So let's go to workings 5. Let's do cost of sales for the 3 marks. We slash in our currency signs. So to get a cost of sales, let's build up from the beginning of the question. So let's bring in the parents' cost of sales. How much we got for the parents? 88,000. So we're going to be bringing in the cost of sales for polyester, 88,000. Then we bring in for our subsidiary, South Star. But remember what I told you about our subsidiary. Any figure about the subsidiary, we pick 6 over 12. So 6 over 12 of South Star's cost of sales. That is 67,500. So if we look at it, what do we have?
66,200.
What?
200. 67,200.
Okay. 200. Okay. So we divide by 2, and that is 33,600. Okay. Then I bring in my depreciation, because they said the depreciation should be charged to cost of sales. Okay. So additional depreciation on leased plant. That's from workings 4. That is going to be the 100 there. So far, I can do this workings as well. And like I said, the movement in fair value, the lease property, will affect my PPE. So I could do workings for PPE in working 6. So we go back to the question. In the assets column, property, plant, and equipment, bring up the figures. So property, plant, and equipment, slashing our currency sign, we bring in Polyester's property. And that is an amount of 41,700. $41,700. Then we bring in our subsidiary, South Star, and that is going to be an amount of 21,000. Please, in the statement of financial position, we don't do ratio and proportion. In the statement of financial position, we pick the entire figure and then we go about it. Then we bring in the fair value adjustment, the leased property. That is 2,000. It was above, so we need to add it back because the entity had understated their assets, so we add it back. Then we bring in the additional depreciation we got from workings 4. The 100, it's going to deduct. The 100 is going to deduct. Yes, Oxbet.
Yeah, so please, if you do this on the face of the financial statement, will you still get the same mark?
When you say will you get the same mark, what do you mean? Like once the figure is correct, it's optional. You can do it on the face of the financial statement. You can do it on the face of the financial statement if you want. But the reason why it is prudent to do it not on the face of the financial statement is about clarity. Because if care is not taking the page the way you are writing, by the time you finish the word PPE, the space left will be limited. And now you'll be squeezing your figures up. And so doing the working separately so that you pick the absolute figure to the statement of financial position enhances faithful representation, and that awards towards professional mark that you can get a portion of at the end of the day. So it's optional. You can do it on the face if you're okay with that.
Okay, thanks.
Right. So that is our footnote 1, and that is what we can do in relation to the footnote 1. That's what we can do in relation to the footnote 1. Again, if we go back to our net asset schedule here, like I said, we're going to be hanging on retained earnings at the date of acquisition because we don't know statements in the footnote. So for now, we're just going to hang it there for now, and we're going to see what will happen there. Note 2. The thing is Polyester, and I've been spelling E-E-E. I've been doing E, and you people do young way. Note 2. Polyester transferred raw materials at their cost of 4 million to South Star. Listen to the language here very well. This is intra-group trading situation. At their cost of $4 million to South Star in June 2013. Now, that is during the post-acquisition period because we acquired them in April and then we are in June. Now, let me say this. Any trading between the two companies pre-acquisition is not canceled on consolidation. Let me make that statement again. Any trading between the two companies pre-acquisition is not canceled on consolidation. What does that mean? It means if we acquire them on April and we had bought from them in January, in February, in March, Yaton, we were separate entities. It doesn't affect the consolidated financial statements. So you have to be careful because sometimes the two entities have been trading already before the acquisition bid was made. In that regard, whatever trading they've been involved in previously does not affect the consolidation. Does not affect the consolidation. Southstar processed all these materials, incurring additional cost of 1.4 million, and sold them back to Polyester in August 2019 for 9 million. It's an interesting situation going on here. So let's see what's happening here. A lot of you messed this up, so please follow it carefully. This is intra-group trading, yeah? And so we need to cancel the actual sales from the sales figure of the entity. Then we cancel it from cost of sales as well. So two things. We already have cost of sales situation. So the sales from, your friend is saying, polyester, the raw material from polyester to Southstar must be canceled first. So intra-group sales. Polyester made a sales of raw materials. And they sold it to them 4 million. So intra-group sales, we're going to deduct that from cost of sales. Then that same figure must be deducted from revenue. So let's go do workings for revenue. Working 7, revenue. Slash in our currency sign. Let's bring revenue for polyester. How much we got for revenue situation? 110,000. Then we bring in Southstar's revenue. Remember, we will pick 6/12 of that figure, 66, 6/12. And so that will be 33,000, if my memory serves me right. Over 2, 33. $33,000. Then we bring in the intra-group sales. First, the raw material will be removed. 4,000 will be canceled. Okay, will be canceled. So that is the raw material part. We've dealt with it. Then look at the second part of the question. Please stay with me carefully. Southstar processed all of these materials, incurring additional cost of $1.4 million, incurring additional cost of $1.4 million, and sold them back to polyester in August for 9,000. Okay, so there are two sales here. I don't know why almost everybody who sent me script on this question was dealing with only one sales. So there is a sale of raw material, then there is a sale of finished goods. So the finished goods sales is 9 million. Eliminate from both revenue and cost of sales. So finished goods, 9 mil. Finished goods, 9 mil. If you have any questions, you ask, raise your hand, I bring you up, or you put it in the chat for me. Very important. So there are two sales here. Sales from polyester to Southstar, sales from Southstar to polyester. AS sales. One is selling raw material, one is selling finished goods. We will cancel. We will cancel. That is very important. Let's continue. At 30th September 2013, polyester had 1.5 million of these goods still in inventory. There were no other intragroup sales. There were no other intragroup sales. There were no other intragroup sales. So the question we ask ourselves is, the closing stock outstanding is 1.5. Yes, Martin.
Is right. The 9 million sales from the subsidiary to the parent, does it affect only the revenue?
It has to affect revenue and cost of sales.
Yeah, but there was we haven't done anything at cost of sales, so only the revenue.
We have brought it already under cost of sales.
Okay.
This is cost of sales. It's already here.
Okay, thank you.
Okay. So the question we ask ourselves is, yes.
Yeah. So when I was doing it, I treated the 9 million. I subtracted it from the revenue. But it's like you circle it. Any reason?
I circled.
Yes, it was circled.
I don't think I remember that very well. If I circled, maybe there's no issue. Maybe there's no issue.
Okay. All right. Thanks.
Oh, okay. So let's continue. Now it says that polyester had 1.5 of these in stock. Now stay with me carefully because it's going to be really a bit tricky here. So the question we ask ourselves is, this 1.5 million in stock, how do we get a provision for unrealized profits on it? How do we go about it? We need to think about what is going on at the end of the day. So there are a couple of ways we can think for the examiner here. So workings 8 intragroup, so that I can get my PUP situation coming up. So intragroup sales. So this is how I will present it up and get my provision for unrealized profit. We realize that the sales for now PUP you are looking at here is from the perspective of South Star to polyester, okay? Because polyster's raw material sales were just at cost. So there's not going to be provision for unrealized profits on the raw material, but the provision for unrealized profits will be on the finished goods situation. So the sales for the finished goods is 9,000. Let's look at the cost that they incurred in that. The cost they incurred include the cost of the inventory, which was what they bought from these guys, and that is an amount of 4,000. Then the additional cost they incurred, which was 1.4, 1,400. We add it up, it becomes 5,400. We subtract it, and that will be the unrealized, or that will be the profit from the sales that they supposed to make. 9,000 minus 5,400, and that is 3,600. But this was the profit they made on the entire 9,000 sales that they made. But it is not all that has been sold. If you remember, we are told that 1.5 is remaining. So that 1.5 that is remaining, how do we get a provision for unrealized profit relating to the 1.5 at the end of the day? Simple. So our provision for unrealized profits can be equal to the inventory remaining divided by the total sales times the profits that we had. The 1,005 over the total sales value of 9,000 times the profit we made, 3,600. So that the provision for unrealized profit on the 1,500 becomes an amount of times 3,600, $600. So that is how we get the provision for unrealized profit relating to this particular question. That is how we get a provision for unrealized profit relating to this particular question. So this provision for unrealized profit, its impact must be reflected in the cost of sales for the period under review, and also reflected on the face of the statement of financial position under inventory, because the journal entry here is we're going to debit cost of sales. When we say debit cost of sales, we mean add it to cost of sales. And then credit inventory. When we say credit inventory, we mean subtract it from inventory. But because it is the subsidiary selling to the associate, that is going to impact on the provision for unrealized profit. So it will impact on their profit for the year. So also subtract it. When I say debit their profit for the year, I mean subtract from the profit for the year. So that is a treatment for the 600. So we go back to cost of sales and bring in the provision for unrealized profit. And that is going to give us an amount of 600 from workings 8. So we bring that up. 600. We add it. Now, like I said, the implication of this has to be reflected in the profit for the year on our company that we are acquiring. Now, and I mentioned also that the profit for the year, yes, George, your hand is up. Okay. If there are any questions, you put it in the chat for me, or you raise your hand, I'll bring you up, then we continue. Now, if you realize I told you that in place of my net asset schedule, I can work out the profit for the year alternatively so that we see exactly what is going on in that particular case. So instead of me doing asset as acquisition and asset at a reporting date, there is an alternative way for me to do profit for the year. So post-acquisition profit or loss of South Star, our subsidiary. What we would do is to bring in first their profit for the year. Look at it. It's actually a loss for the year, 4,600. So we bring it up. So loss for the year. Remember, it is 6/12. So I'm going to do 6/12 times 4,600. So that is 4,600 divided by 2. That is 2,300. Remember, it is a loss. So you put that in brackets. Now, stay with me carefully. Then you remember there was a fair value adjustment relating to the additional depreciation. We did a calculation for that a moment ago. And we got, okay, it's even just here. We got 100. Now, you have to be careful about the treatment here in relation to this. Now, it was a loss they made. Where's my workings? Sorry. Okay, this is it. So that is from the workings there, 100. We bring it up. We bring that up, 100. Then there was a provision for unrealized profit because they had sold to the parent. And we did a workings for that from workings something workings 8. And that was 600. Does that make sense? So instead of us doing net asset at acquisition, net asset at the reporting date, alternatively, this is how we can prepare the post-acquisition profit or loss by bringing profit or loss for the year, and then we adjust it with fair value adjustment. We are not done. I'm just letting you know how the workings could be done at the end of the day. Any questions, please? Raise your hand, I bring you up, and then or you put it in the chat for me. Some chat on YouTube. Kwabena Ohene said, please explain at acquisition at year end. How do we know them? Okay, I think I've already explained that. Samuel Kadula said, good evening, sir. Good evening. Zamzilu, good evening, sir. We appreciate your continuous support. Please, what is the treatment of dividend analysis on CFS? What is CFS? Sam said, we appreciate your help, sir. Straight from Kampala. Okay. Timothy said, good evening. My regards to Martino. Martin, Timothy said, shout outs to you.
Thank you.
All right, let's continue. So that is the note I. That's now remaining one treatment. The provision for unrealized profit must go to statement of financial position and subtract from inventory. We could do that on the face of the financial statement. Okay. If you look at this question, it has no inventory. What it has is cost of sales. We could do the workings or bring it on the face of the financial statements. I think it would make sense for us to just do the workings for it since we are at it, so that we can do it on the face though, but whatever be the case. So current assets, so that we know the implication of whatever treatment we've picked. So let's pick polyester, current asset situation. That's 16,500. Then we bring Salt Star. That will be brought as 4,800. Then we bring the issue relating to the provision for realized profit. That must be subtracted from inventory. And that was from workings 8. That is 600 to be deducted there in that regard. I'm seeing some charts coming in on Zoom. Please go over the PUP of 600. Okay. What we are saying is that the sales for the year from polyester to, how do we call it? From Salt Star, the subsidiary, to polyester is 9,000. But then they incurred some costs in arriving at that sale. So we want the profit on the sales of the inventory. So they bought it at 4,000 from polyester. So that is the cost of the inventory or the cost of the raw material. But then they incurred an additional cost of 1.4. They incurred an additional cost of 1.4. So we pull that up as an additional cost that they incur for the period. Then we subtract that. So the two will become 5,400. Then we subtract that from the sales. That means the sales that they made to polyester, they made a profit of what? 3,600. The reason is that the total raw material 4,000 they bought from polyester, that is what they added value and resold the entire thing back to polyester. Hence, the total profit arrived on this particular deal is 3,600. But then we have 1.5 available. So if the entity sold 9,000 and it has 1.5 available, then we will do ratio and proportion, goods remaining divided by the total sales times the profit that we made on the total sales. So that we'll get a profit attributable or the profit component in the 1,005 inventory remaining. And that arithmetically is what gives us the 600. That is the arithmetically what gives us the 600. So this 600 is the profit element in the 1,005 inventory that polyester still has in stock. Does that make sense? Okay. Then Kofi said, sir, please, at what point do we apply cost minus sales for the calculation of PUP? It's cost minus sales. When will you do? You can't do cost minus sales, or you want to do sales minus cost. It depends on the structure of the question. You know, in this question, for instance, we are not giving percentage of the percentage at which they sold the thing at the end of the day. So that is why we are going with this approach to arrive at a selling price. So I don't get the context of your apply cost minus sales. I don't know what that means. Maybe you can contextualize for me. Then I can provide you with some answers on that. Yes, Oxbert, your hand is up.
Please, the profit for the year, you know, when you left it blank, you were saying that we want to see whether they will pay dividend. If they had paid dividend, how would that have been the treatment?
We are not done, right? So let's finish the note, then we'll see. Then
Okay.
I'll answer your question for you as well when we get there.
Okay, all right.
Okay. Yes, James.
Sir, please, assuming there was impairment of the inventory, would it have been the opposite treatment?
I don't understand.
Like the inventory, that the one that the subsidiary. So if there was impairment or there was a loss in the this thing, a decrease in the inventory at the end of the period, What would have been the alternative?
If they sold it to them at a price less than the cost they incurred, then that would be a loss. The issue is provision for unrealized profit or loss. That is a statement. So if they sold it at a price less than the cost they incurred, then it's a loss. Then in that case, it will be subtracted from their cost of sales. It will be added back to their profit for the year. And then we add it back as well to the current asset on the face of the statement of financial position.
Sir, thank you.
Right. Yes, George, your hand is up.
I
Yes.
went up, so I went up, but I have followed the 3,006. I want to know how we use the 1,005, the one left over the sales 9,000 times 36 to get a PUP.
Yeah, because in the question we are told that polyester had 1.5 of the inventories available at the end of the year. So if polyester has inventory of 1.5 available at the end of the year, and they sold 9,000 to them, then 1,005 over the total sales 9,000 times the profit, which is 3,600, so that we will get a 600 at the end of the day as the provision for unrealized profit. So that is how we got 1,005, because that is the inventory remained at the end of the year. Does that make sense?
Okay, sir. So you use what is left over the total sales that is sold to polyester.
That's right.
Times the PUP to get the provision for
times the profit they made on the total sales to get a provision for unrealized profit.
Okay, sir. Okay, sir. So, sir, what about the total sales? Where will it go?
We've already deducted it.
3,600.
No, we don't care the total profit. We don't care about the total profit. We are only concerned about the profit on the unsold goods.
Okay.
So it is only the 600 we are careful about, and that is what we would use. So the 3,600, we don't do anything to it. Okay, Rose, your hand is up.
Okay. So I was wondering, the 600, why didn't we apportion it? Why didn't
the 600?
The 600 from the PUP, why didn't we, the 6 over 12, why didn't we do that?
No, with provision for unrealized profit, we don't do ratio and proportion, because that is the amount that we have not sold yet. So that one, we don't take a portion of it. Whatever figure we get is what we will use in our inventory and then cost of sales and group retained earnings or wherever else we have to use it. So we don't apportion the group provision for unrealized profit.
Thank you very much.
All right. Yes, Josephine.
Nhyira,
Ma.
please, can you throw light on why we are lessing the PUP from the retained earnings?
Hey, no, we have not brought retained earnings, oh, mommy.
Oh, sorry, I mean the net asset schedule.
Have we? I've not even brought it in net asset schedule yet. Oh, I've not brought it yet. I'm now coming to write it.
In determining the profit, the other way of determining
the
profit, you brought it there.
Yes, because they've not earned that profit. Because if you realize, this was the double entry we said. This was the double entry. Debit cost of sales or debit the profit for the year of the subsidiary. So when we are debiting the profit keeps a credit balance. So when we are debiting the profit, it means you subtract it. So always provision for unrealized profit will be subtracted from the profit for the year of the entity. That is why if you come to the net asset schedule, since it is a subsidiary selling, we could have brought PUP here and bring the 600 here as a negative, and it goes here also as a negative. Does that make sense?
Yes, sir. Thank you.
Okay. Any other questions, please? Any other questions? Anita Donko said, please, how can I get a question we are solving? You can send a message on Telegram, and we can send it to you on Telegram in that case. So that is how you can get a question in relation to that. Yes, George.
Hello, sir.
Yes.
I want to see the entry that will go to inventory and the 600, the 600.
That will go to where? The
The
600
cost
is
of
the 600 is posted to cost of sales, subtract, current assets, subtract, profit for the year, subtract. So it's in the cost of sales here. Sorry, cost of sales we add because it was a profit. Because when we debit cost of sales, it means you are adding it to the cost of sales. It means you are adding it to the cost of sales. So that is the issue there in that regard. Okay. So that is it about that footnote. Again, make sure you get a bit very well. So there are two things here. Like I said, the script we got, like many people just dealt with the one. I think the 9,000. For some reason, the 4,000 they are like, oh, Nhyira, I ain't doing anything about that. So let's go to the note 3. I. Poleste's policy is to value non-controlling interest at fair value at the date of acquisition. For this purpose, Southstar's share price, at the date can be deemed to be representative of the fair value of the shares held by non-controlling interest. Easy now. You remember we were given the share price of Southstar in the beginning, and I told you that we don't know. So this is where we use it. We always use the share price of the subsidiary to value NCI if NCI is valued using the number of shares they own. So let's go to NCI. We're going to do workings for NCI. Because we are doing statement of financial position, we need NCI at the reporting date. So non-controlling interest. Slashing the currency signs. Fair value at acquisition. Remember they own 25%. If you remember, the shares of the company is 12,000. You remember that, right? We did workings for that in workings 2. Let me go refer you to it. So you know we are not picking the figures out of the blue. Sorry, workings 3 rather. The number of shares, 12,000. So you go pick that. So that's what we are bringing up here. Workings 3. Multiply by the share price of the subsidiary, $1.2. That's how we get our fair value of NCI transferred. NCI, the acquisition date, 0.25, 12,000, 1.2, and I'm getting 3,600 for the NCI. 3,600 for the NCI. 3,600 for the NCI. Yes, Josephine.
Sure. For instance, if you've been given a question where they don't give you the share price of the subsidiary, but in the question, the share, the ordinary shares, the capital, they said maybe 1 cedi at a certain value. Do you use the 1 cedi to?
Never.
Okay.
If the share price of the subsidiary is not given, then NCI will be valued using the other two methods, either the proportionate of the net asset at acquisition or the fair value as per the director's agreement. So if we have to use the shares they own, then we have to use the share price of the subsidiary. So if the share price of the subsidiary is not available, then NCI will be valued either by the directors of the company. So a fixed figure will be given to us, which we will use, or the examiner will say we are using the proportionate approach, which is the percentage of their ownership of the net asset at acquisition. Does that make sense?
Yeah. No, please, can you come again?
I said that there is no way the examiner will say use or value like this statement will be given. There is no way we will have a statement like the III. Okay. There's no way we'll have a statement like this and the share price of the subsidiary is not given. There is no way. There is no way. So if the examiner doesn't want you to use the share that they own, then the examiner will say, okay, Polyster's policy is to value non-controlling interest at fair value. At the date of acquisition, directors have deemed the fair value of Polyester to be 5,000. Then in that case, that 5,000 becomes NCI at acquisition. Or the directors will say they value NCI using the proportionate method. In that case, it will be their percentage of ownership times the net asset of the subsidiary at the date of acquisition. Does that make sense now?
Yes, sir.
Okay. Yes, James.
Sir, please, a situation, can there be a situation whereby they will not give you net asset at acquisition? That's first one. Or maybe there's information about only the stated capital, and then later on you have the share price of the entity. Which one do you go for?
I don't understand the context of your question.
I'm saying, is there any situation whereby you will not be giving the net asset of the subsidiary at acquisition? That is the first one. Or where at acquisition, there's no information concerning that, but when you look at the statement of financial position, you saw the stated capital of the subsidiary, but without other information.
There is no way you have that. There is always information available for you to get your net asset at acquisition. Either the examiner will directly state it to you if he doesn't want you to work for it, or the share capital, share premium, retained earnings, all these things will be part of the equity aspect that will be available, and there will be additional information on how you can arrive at it. So there will be no way for you that you have to find that yourself or something like that. There will be information to arrive at net asset at acquisition always.
Please follow in a question. Is there any a maximum, or can you get a question maybe only the stated capital or one of it?
I don't get this statement. Well, statement. What are you coming at? Like, what is the context of it?
We know that following that, we know that the net assets at acquisition, you can get the stated capital, you can get retained earning or surplus. I'm saying, is there a limit where the stated capital will be the net asset at acquisition will be limited to, let's say, only retained earning in a question, or
no, the companies always have share capital. So information about net assets will always be share capital coming in. Share premium could be in the question. This question is not there. Share premium could be in. Retained earnings could be in there. Then certainly fair value adjustment will come in. So there is no limitation on whether you have only retained earnings or whether you have only share capital, because these things will always be available in the question.
Okay, thank you, sir.
Right.
Nhyira,
Yes.
please, I want to make some clarification. The other time is that you said if the NCI is valued at the proportionate method, impairment in goodwill is borne by only the parent, right?
Right. Yeah, that's true.
Okay, and then if it is true fair value, then it will be shared between non-controlling interest and then the parent, right?
That's right.
Okay, all right, thanks.
Right. So once we have a fair value of NCI at acquisition, I could bring it up to my goodwill, free marks on goodwill. So fair value of NCI from Workington, 3,600. Free marks, allowed to have free marks there, and get my 10 up. Okay. Then it says all items in the above statement of profit or loss are deemed to accrued evenly. Even if the examiner doesn't say it, we know. Accrued evenly means like it is assumed that it's on a monthly basis, it's equal. That is why I told you that in the statement of profit or loss, we'll take 6/12. Okay, because we assume that all the amounts accrued evenly. All the amounts accrued evenly. So that statement there is just, we call it garnishing statements, okay? If you are good at food when food is prepared, it must be garnished. So this one is just garnishing the question to make the question look more attractive, more beautiful, more nice, but you don't use it for anything because, I mean, after they garnish the food and your taste bud rises, you eat it and that is all. So that we won't use that information for anything, but it's just confirming the treatment of what we need to look out for at the end of the day. Please, goodwill screen for 5 seconds. We will come back to goodwill, don't worry. Here we are. Okay, so we have finished reading the question. So let's figure out the loopholes that we need to figure out. So let's go and bring the fair value of the business. You know, the fair value of the business here will be polyester, definitely. Please, the polyester, you have made me write E. It is A. So when you are writing, write A. Me, I've done E throughout. So I'm just staying with my E. I can't go and clean. So do the right name. So that's going to be 18,900 for my goodwill. Sorry, for my business, yeah. 18,900. Then we less net asset at acquisition. Net asset at acquisition. So we go back to our net asset schedule. So the question we ask ourselves is, okay, there is a question mark on the situation relating to how we get retained earnings at the date of acquisition. So the question we ask ourselves is, how do we get the retained earnings at the date of acquisition? That is a question we ask ourselves. Okay. Now, let me make it a statement so that we go ahead in that case. You realize that the profit for the year, we said 6 months belong to the company. All right. So there is a way we can find retained earnings at the date of acquisition. Again, there is another way we could also calculate the net assets at acquisition. I'm going to show you the alternative ways, then we go away. But retained earnings at acquisition could be calculated this way. So retained earnings at acquisition. If we want the retained earnings at acquisition, alternatively, we could go this way. We could bring in the closing retained earnings, which is the 12,000 we got. The 12,000 we got because it was 12,000 at the closing date. We even used it here. Okay. Then they didn't pay any dividend. Okay. But then they made a loss. They made a loss. They made a loss. And if you look at the question, they made a loss of, I'm going too much up, 4,600. And we said half of that relates to the current year and half of that relates to the previous year. So if they made a loss of 600, that means, 4,600, that 4,600 was deducted in arriving at this 12,000. Do you agree with that? Because your normal retained earnings is like this. You bring the balance brought forward, the opening balance, then you add profit or you less the loss. So if it is profit, you add it. If it is loss, you subtract. And that is what gives you what? The closing balance, because they didn't pay any dividend. So the question is, if you have the closing balance and you have the profit for the year, can you do the pre-acquisition figure? Yeah, you can get a pre-acquisition figure. So if the closing figure is 12,000, we can bring in the pre-acquisition profit for the year. Sorry, pre-acquisition loss for the year. What do we have in that particular case? 4,600 times 6/12. And that will be an amount of, how do we call it? 2,300. Now, stay with me carefully. It was a loss they made. So that means that it was deducted in the opening figure. So if I should go with this approach here, the closing figure is 12,000. so that you understand what is going on. 12,000. Then they made a loss of 2,300. That is supposed to be deducted at the end of the day. Let me go this way. Let me bring out the entire loss of 4,600. So that the retained earnings at the date of acquisition will be what? Let's see, we'll have to add back. So that will be 12,000 plus
16,600.
16,600. So this will become then the retained earnings at the date or at the beginning of the year, not at the date of acquisition, but at the beginning of the year. This will be the retained earnings at the beginning of the year. Please, everybody understand this before I move on to the pre-acquisition profit. So you have your closing balance. They made a loss of 4,600 for the year. It was deducted from the opening. That was why they got a closing of 12,000. So now it means at the beginning of the year, they had an opening balance of 16,400. So it means that our retained earnings at the date of acquisition will be 16,400.
600.
16,600. Thank you. 16,600. And I'm going to show you something here. Now, so if this was the acquisition profit for the year, they made a loss. So the pre-acquisition loss impact must be brought into the date of acquisition. So we will bring in pre-acquisition loss for the year. Please stay with me carefully. It is just 6 months. So the loss of 4,600, you remembered I took only half of that when I was dealing with profit or loss. So that half relates to a loss they had before we came in. So since it is a loss they have had, that half loss, 4,600 divided by 2 will be 2,300. At the date of acquisition will be deducted. If it was a profit they made, the pre-acquisition profit for the year will be added at the date of acquisition. Any questions, please? Any questions? Any questions? Any questions?
Nhyira, please, I lost connection. Can you kindly go over for me?
Go over which one?
The retained earnings.
Yeah, so we said the retained earnings at the date of acquisition will be, or at the beginning of the year, sorry. The retained earnings at the beginning of the year will be the closing balance, the loss for the year, so that the balancing figure becomes the opening retained earnings, 16,600. So it means that the opening retained earnings brought forward is 16,600. But you see, the year's profit, they had made, the year loss, they had earned 6 months of that loss before we acquired them. So the pre-acquisition loss for the year, we must bring that half and subtract it from the net asset at the date of acquisition. And that is where the 2,300 is coming in at the year end. Does that make sense for you, Oxbet? David, your hand is up.
Yeah, thanks.
So please, I wanted to know, like, in calculating for the retained earnings at acquisition, can you maybe work out the loss they made in the year and then deduct it or add it back to the closing in order to prevent you from also coming back and then deduct it in the face of the net asset schedule?
Yeah, it depends on the way you want to structure your things out. Because of the structure of the way the question is, we could say, let's find a way to build up half, but it will be prudent for you to have the retained earnings at the beginning of the year so that you can then adjust for the pre-acquisition profit or loss. Okay, so that you can then adjust for the pre-acquisition profit or loss. The reason is that the closing balance of 12,000 is inclusive of the entire loss for the year. It's inclusive of the entire loss for the year. So if you just pick a portion of the loss from the 12,000, you are likely going to be affected at the end of the day at your balancing figure coming in. So it will be prudent for us to have the retained earning at the beginning of the year. Then we will add the loss coming in for the year. That will be the prudent way for us to get it, because the impact here is a loss. And when there is an impact of loss, taking the pre-acquisition loss to arrive at the closing figure will be some way, because this closing figure includes not just this year, but all the years that probably the business has been in operation. So it will be just prudent for us to have the opening figure coming in, and then the pre-acquisition profits for the year will be brought in, as far as it is not a full year acquisition. As far as not a full year acquisition. If this question was a full year acquisition, then there will not be a need for the pre-acquisition. Then the dates at the beginning of the year, 16,600, will end there. But because of the fact that there is that half year or mid-year acquisition, that is why we have to bring that up as a separate item on the face of the financial statement. Does that make sense for you?
Thank you, sir.
Right. So let's see what is happening at the end of the day. So this one will go here to 300. So let's get net asset at the end of the year, net asset at the date of acquisition. Let's get the movement coming in for the period. Can we add up? Okay, I'm getting 22,300 here. Please confirm. And I'll get a total of 3,000 here as the loss. Then the net asset at the reporting date, I don't even need that though, but 20,000 minus 700, and I'm getting 19,300. You can confirm. So this is our net asset schedule. This is our net asset schedule. Now, if you realize, you will see that this adjustment we did here, it's also giving us the post-acquisition loss to be what? 3,000. So you choose your choice, which one you are comfortable with. Is it your net asset schedule, or you go with this swag? You realize that if you are going with this swag, then you don't have to think about pre-acquisition stories, situation, splitting the things, finding the retained earning at the beginning of the year. You don't worry yourself with that headache. If you go by this, it's there. But like I said, I'm up for it. My role is to teach you to understand. Whichever swag you are comfortable with, please stay with it. You stay with it. So that is the issue there for our net asset schedule as well. And that profit or loss is going to be shared between the parent and the NCI for the period. Did I write 2,300 here? It should be 3,000. Sorry. 3,000 loss. Any questions, please? Yes, James.
Sir, please, the next, as I said, the 22, the movement, is it not positive 2,300? Because you have
why can a company make a loss and you say movement should be positive?
I said because of the presentation, reporting minus the acquisition, and that's what mathematical, that's what I'm asking.
It is not about mathematics, it's about the loss they made. They made a loss. So why will you say positive, negative? It's a loss they made, so the movement is going to be a loss, technically. Are you getting it? Because 0 minus 2,300 is going to be there in that case. Forget about minus. Just stay with the absolute figures here and work your way out at the end of the day.
Okay. Thank you.
Nhyira,
Okay. Yeah.
please, the difference, the retained earning, you see there's a difference there. The
Okay.
reporting is 12,000, and then the acquisition is 16,600.
That will be how much? So that will be 16,600. So we can, oh, minus 12,000. I didn't even check that. That'll be like 4,600. And that is a reduction coming in. No, then that means there's a problem with my retained earnings at the date of acquisition. Let me check it again. Maybe there's a problem with my retained earnings at acquisition.
So it's like the balancing figure is 7,400.
No, I'm coming. That means there is an issue, because if I look at acquisition, okay, this is at the beginning of the year. Okay, the 16,600 is at the beginning of the year. It makes sense. Oh, I know where it's coming from. The idea is that if we are taking the reporting date, 12,000 figure coming up, and we are saying that the retained earnings at acquisition is 16,600. Let me see. I'm trying to think about where the response is, because we are supposed to get the same idea irrespective of the approach that we're going for. So that means there's a problem. Oh, okay. I understand. I know what is happening now. So this is the deal. Since we are going to be adjusting the profit for the year relating to the pre-acquisition profit, then in that case, all we need to do is the retained earnings at the date of acquisition. We maintain the 12,000 at both ends. Then we'll do the adjustment coming in from the issue in relation to this point. But that, no. My brain needs something about this. Oh my God, give me a moment. Let me see if I can process this well.
But where from that 16,600 figure? It's like I'm not getting.
No, that was the opening retained earnings at the beginning of the year. So I'm coming. I'm thinking about it. Retain at the beginning of the year. Give me a moment. Let me think about it.
There's an issue.
Hello, Nhyira.
There's an issue, sir. There's an issue about the adjustment of the retained earnings figure. Yeah, Roland.
Yeah, I'm thinking the opening retained earnings should be 14,300. We only take the pre-acquisition profit, which is 2,300, then we add it to the 12,000. That's what I'm thinking. Is then that we can get the 3,000.
Because the impact of the entire 4,300 had been taken into consideration in arriving at the 16,400. Yes, because the impact of the entire 300 has been taken into consideration in arriving at this.
Okay.
I think I understand your point. Just that I'm trying to process what is happening. So let's bring that up again. So our closing balance is 12,000 coming in here. We need our opening balance, or the balance at acquisition. So if we want balance at acquisition, we don't know that. That will be the balancing figure. Then we bring in the pre-acquisition loss. First, you bring pre-acquisition loss. That'll be 4,600 divided by 2. That should be 2,300. So that means since this was subtracted, we added up, and that will become an amount of how much? 12,000 plus 2,300. 14,300. So that will be retained earnings at acquisition. This will make a better sense. But then if that becomes 14,300 plus 6,000 plus 2,000. Yes, that should be the treatment. That should be the treatment instead. This should be the treatment. Because the rationale is this, because the entire 4,300 effect has been taken into consideration in arriving at the 16,400.
Yeah.
Okay, in arriving at the 16,400. So if we take that, that means we have double counted the 2,300 amount coming in here. So then in that case, for us to get a retained earning at the date of acquisition, then we'll just deduct our pre-acquisition loss, which is going to be the 6 months before they existed. That will give us our retained earnings at acquisition to be 14,300. That will give us our retained earnings at acquisition to be 14,300 in that case. Now, if we have that to be 14,300, assuming that is coming in, again, there is still going to be a movement. Like if you are going by the movement, it is still going to be what? A movement. But then in that case, if you look at the total figures, 6,000 plus 14,300 plus 2,000 minus, I'm coming now.
So it means we'll no longer deduct the pre-acquisition loss because we've already taken
because
care
we've
of it.
already treated it already. So
Yes.
it will no longer come here.
Yes.
Actually, when I was looking at this question, I'm coming. Yeah.
But I think when we take the 16,600 and after that after that when we do the we take the pre-acquisition loss, you still get the same difference of 3,000.
So relax.
Yes. So
actually,
so
when I was looking at this question,
treatment.
When I was looking at this question, I didn't look at the net asset schedule. Okay, I just jumped in with this approach, like went away. So I didn't look at the net asset schedule approach at the end of the day. So let me see, because that issue has to be resolved for the net assets squad so that we can get the approach coming in. So let me see, closing balance, we get the net asset at acquisition 14,300. In that case, since we have adjusted the pre-acquisition profit, then I will not bring this up again at the end of the day. That makes sense. Then we will not do the pre-adjustment here. Then Sanka, it should come at the end of the day. It should give us the same figure.
Nhyira.
Yes.
You get the same figure. I'm coming on.
Because say we be my negative 2,300.
Yes.
So that
we
if
still
we
get our 3,000.
If we
still
take
get the
the
3,000, so I think there's no
out,
difference.
So there will be a difference of 3,000 coming in. So really, there is no difference. The issue rising up is this, that you are thinking about the movement individually. So if you think about the movement individually, then that is going to affect what? Your answer. But if you are thinking about the total movement, that is comparing this figure with this figure, then your net 3,000 will be the same. Are you getting the idea?
Yes.
That is why, like, if you remember, I hardly talk about the issue about movement coming in. Because if you go with a movement approach, then our first approach will seem that it is wrong. But technically, that approach is correct because we brought in the total profit up. Then we came to do the adjustment for the pre-acquisition. And that was why we got 16,000. But then in that case, we are thinking about movement. So then the movement will be wrong at the end of the day. So what am I saying? What I'm saying is that the movement column, if it is in my opinion, don't bring it. Like, it's not something that has to be brought. Because if we keep the 16,400 here, how much did we get? Is it 16,600? The figure we had here. Yeah. If we kept the 16,600 and we adjusted, we will still get our 22,300. And that will still lead us to the negative 3,000. But then now you are thinking about, oh, how do I deal with the movement here? Because there's a movement. Forget about the movement. Which means that, like, the movement column is going to what? Affect. If you want to look at the movement. So alternatively, then you do the adjustment like this, like we did here. Then in that case, no pre-acquisition what? Adjustments. Then you can stay with that figure and get your right movement and come in there. So I think it's about approach. It's about approach. It's about approach at the end of the day. So you choose the approach that you are comfortable with at the end of the day, but making sure that you are getting the right figures that must be used for your treatment. Making sure that you get the right figures that must be used for your treatment. So maybe since I have the luxury to clean, so I can clean this one up. I can just clean this one up and then bring in the figure that we had here, which is how much? 14,300. From the workings. In that way, we keep our movement coming in at the end of the day. So that should be the amount there. So we don't then bring in the pre-acquisition figure for the period. I hope that makes sense, because whatever approach you use, your post-acquisition profit figure must be the same as going with the alternative approach presentation. Going with the alternative approach presentation. Okay, thank you for that. So once we get a loss for the year, it must be shared between controlling interest and non-controlling interest. So it is 3,000. We have non-controlling interest already. Let's go bring it. Share of post-acquisition loss. And that is going to be, they own 25%. So 25% of 3,000. So 0.25 of 3,000. That's 750. Remember, it's a loss, so you deduct it. So you get a carrying amount minus 3,600 of 2,850. And that is what will go to the statement of financial position. That is what will go to the statement of financial position. So that's our controlling interest. Then workings 11 will be group retained earnings or consolidated retained earnings. We bring in the group retained earnings. So we bring Polyester's retained earnings. How much is Polyester retained earnings? That is 28,800. Then we bring in the issue about the share of the post-acquisition loss. The share of post-acquisition loss. And that is going to be 75% of 3,000. And 3,000 by 0.75, 2250. It's a loss, so you're going to deduct it at the end of the day. Yes, George? Sorry. I think your network is not good. You can put your comment in the chat for us, and then we can pick you up.
So about the post-acquisition profit, the other alternate. Can you please go back? But this one is confusing me more.
I didn't get what you said. Put your statement in the chat for us. I think your network was breaking so that we can pick you up. So the net asset at acquisition, we got it at 22,300. So we go back to our goodwill workings for 22,300. And it's resulting into negative goodwill. $22,300 minus $18,900. Negative goodwill of 3,400. Now that is a gain. So we add it to the consolidated retained earnings, gain on acquisition from workings 2, 3,400 for the period. Okay. It looks like we are done. So there was no impairment in goodwill. So we can add it up and close it. 28,800 minus 22,50. And I get 29,950 for the group retained earnings. Oh, my retained earnings is 28,500. Please check my figures. So 28,500 minus 2250 plus 3,400, getting 29,650. That is the closing figure for the group retained earnings. Current asset, we are done. Nothing else is going to go here. 16,500 plus 4,800 minus 600, 2,700 for the current asset for the year under review. Intragroup trading, we've solved the issue there. Revenue, let's get the total coming up. 110,000 plus 33,000 minus 4,000 minus 9,000. And our total revenue is an amount of 130,000. So we get a figure coming in. Working 6, property, plant, and equipment. We've done the various adjustments that must be done. So we added up 41,700 plus 21,000 plus 2,000 minus 100. And that is 64,600. In that case, for the property, plant, and equipment, we go to cost of sales, add it up. We are done with the issues, 88,000 plus 33,600 plus 100 minus 4,000 minus 9,000 plus 600. And that gives us an amount of 109,300. 109,300 for cost of sales. Then we come down, post-acquisition profit or loss. We've dealt with that already. And everything else has been dealt with. So we are done. So now we can prepare our consolidated cash flow, consolidated profit or loss, and then the position for the question relating to that. Okay, thank you. So let's put the pieces together in the A aspect of the question. So polyester group slashing our the first part of the question. What did they say we should do? Statement of profit or loss for the year ended 30th September. For the year ended 30th/9/2013. Slashing our currency sign. We bring in the revenue. We did the workings for that. Bring in cost of sales. We did the workings for that. So let's go and pick up the revenue from working 7, 130,000. Then cost of sales, workings 5, 109,300. We subtract it. To give us gross profit. Okay, I have 109 on my calculator. So 130,000. I get 20,700. Then we bring in the other items based on the question. You can see distribution cost. Remember the information of South Star, we pick 6/12. So we bring that up quickly. South Star, 6/12, distribution cost 3,000 and 2,000. So distribution cost 3,000 plus 2,000, 6/12. And that would be 1,000, that would be 4,000 coming in. Then the next item is administrative expenses. We bring that up. So admin expenses. The parent is 5,250, then 2,400. Plus 2,400. 6/12. Then we get an answer of 5,250 plus 1,200. That is 6,450. But remember, there was a gain on the disposal, sorry, on the acquisition. So profit on acquisition or negative goodwill we had. Workings 5, sorry, it was workings 2. And we got an amount there of 3,400. Must be brought here for the period under review for our admin expenses coming in at the end of the day as a positive figure there. Then finance cost, we bring it up. And it is only our company that has finance cost 250. That's going to be deducted. So you bring it up, minus this. So 2,400, 2,700 minus 4,000 minus 6,450 plus 3,400 minus 250. We get 13,400. And that is profit before tax. Then we can bring in the income tax situation. You have to be careful about the income tax. Watch it carefully. Watch it carefully here. Because almost everybody missed it. There's only one person who got it. Income tax is negative here, but it is positive here. Meaning the company had some, whatever, maybe some deferred tax situation coming in, we don't know. So it's a positive. It's a positive, not a negative for them. So what do? Income tax. We bring in our figure 3,500 for the parent. Now, instead of adding, we will subtract 1,000 times 6/12. Okay, instead of adding, we will subtract because their figure is positive so that we get an amount of 3,000 negative. Does that make sense? And the balancing figure gives us the profit for the year. Profit for the year. And that is 10,400. I hope you get that. Please, the total cost of sales is 101,100. Are you sure? Is it 101,100 cost of sales? Who is confirming that? It's 101,300 per my punching. I don't know. can check your arithmetic situation. And someone else can.
Right, 109,300.
Okay. So Josephine, sorry, not Josephine, Joseph, check your figure. So once you get your profit for the year, you must share it. So profit attributable to owners of the parent. So equity shareholders. Equity shareholders. That's going to be the balancing figure. Don't worry about it. Then you bring non-controlling interest. Non-controlling interest, we've done workings for their share of profit for the year. If you remember, 250. So from workings 10, you bring it up. 750. The total you are sharing is 10,400. So the balancing figure will become what will go to the owners of the business. And that is an amount of plus 11,150. Remember, the company made a loss. That's why you are negating that figure. If there was profit, the two should have been added, but they made a loss. So that is why NCI portion is negated in this question. Normally, NCI will be positive figure, but we are negating the NCI figure here because the company made a loss in the post-acquisition period. And that is your profit, the statement of profit or loss accounts. Any questions, please?
So, Nhyira, yeah, it's because instead of maybe deducting, you have to add.
Yes, you have to add it back to the 10,400, so you get the equity shareholders, their figure. Let's do position. I didn't add consolidation to this word. You people, you are not correcting your teacher. When it's wrong, then you are also copying like that. Should be consolidated statement of profit or loss. Then we go to consolidated statement of financial position. We drop it up. Position situation, we bring in our assets coming up for the period under review. So non-current assets. Somebody was bringing goodwill on the face of this financial statement when there was no goodwill. When the goodwill was negative, somebody was still bringing it. You know yourself. You know yourself already. So property, plants, and equipment, you need to be caned. We whip you about us. So property, plants, and equipment, working 64,600. 64,600. Then I think current assets was directly given. They didn't have a breakdown, and we did the workings for that. So let's go pick it up. From workings 9, 2,700. You see the way our financial statement is clean so that we get total asset. Oh, how much would that be? 64,600 plus 2,700, 85,300. Then equity and liability. Equity and liability. So we bring in the equity. So under equity, we bring, what do we have? We have equity shares, 30,000. It is only the parent figure that is brought. 30,000. You can do the breakdown, 30 cents situation and bring it up. Then retained earnings, we did a calculation for that. So you go bring up the figure. Workings something, workings 11, 29,650. 29,650. 29,650. There was no share premium situation coming in the financial position for the parent. So we bring it up. So you add it, and that should be 59,650. Then you bring in your non-controlling interest at the reporting date. So you see that once you're able to do your workings, the financial statement becomes a flow. Now, NCI, we did workings for that from workings 10, and that is 2850. So workings 10, 2850, so that this becomes total equity. And you add it to it, plus 2850, and that is 88,150 coming in. No, I made a mistake. 59,650 plus 2850, 62,500. Then what else we got? Let's see. We see current liabilities, 15,700. So you bring it up. Current liabilities. That is an amount of 15,000 plus 7,800. So we add it up to bring it in. 15,000 plus 7,800. That's 22,800. And that gives us total equity and liability. And 85,300. Where's my total assets? Okay, it's up there, 85,300. So that's total equity and liability. Any questions, please? 85,300. So that is also the statement of financial position. Yes, Mary. Please say Ibazi. Ibazi for me. Any questions? Okay, I'm seeing a chat. What happens to the profit attributable shareholders? What happened to profit attributable shareholders? I don't understand that statement. Do you mean this figure, this 11? Is that what you're talking about? Are you talking about this figure here? Nothing happens to it. It stays there. It stays there. Yeah, nothing happens to it. It stays there. It's just something that happens in the P&L account. It doesn't go anywhere else. Its beginning and end will be in the P&L account. So we don't take it anywhere. Okay, you're welcome. Yes, James.
Assuming the cost of investment was in exchange of shares, what would have been the entry at the retained earnings column?
That will be dealt with another question in a moment. So you stay tuned.
Okay, thank you.
Please, can you go over the post-acquisition period for the alternative method? What we said there was, let me go to my slide on that. This is it. You bring in the loss for the year for the post-acquisition period is 6 months. So the loss was 4,600. We take 6/12 of that. Then the additional depreciation coming in due to the fair value adjustment, 100. Then the provision for unrealized profit we work for, will also be subtracted. So in total, the post-acquisition period, negative 3,000. That is the answer to the question. And that is the post-acquisition profit or loss. So that is the first question there. We take some 5 minutes break, less than that. And then we'll come and do the second question quickly. Yes.
Please, the dividend issue I was asking, you said you addressed it.
What was the issue? What was the statement you made?
So like the retained earnings, if they had paid dividend.
Yeah, if it had paid dividend, it would be deducted from the closing balance. So certainly, like I said, the balance brought down, which is the closing balance, will be brought. Profit for the year that they have made, profit or loss. If the year they made a profit, we will subtract it. Sorry, profit would have been added into that. So we subtract profit. If loss, we add it back. Then the dividend was subtracted in arriving at the closing balance. So you add back any dividend. So dividend paid by the entity will be added back. And that would have given you the opening balance. Does that make sense? So the dividend is added back to the figure because it was subtracted from the opening in arriving at the closing. So you add it back in arriving at the opening figure.
Okay, thanks.
Right. Okay, so we take a short, like just 5 minutes recess, and then we'll come back in a few minutes. So just some 3 to 5 minutes, and then we'll come back to come and do the second question as I post the second question on the page for us. Hello. Okay. So let's zoom in. Now, break time is over. On YouTube, I'm seeing some comments coming in. Let's see if I can address them as we proceed with our discussion quickly. Umaru said, Jaya Musa, so glad to join this session today. Okay, that's awesome. Hafiz said, Nhyira, thank you. Though on hook late. Okay. Hey. Mumuni said, please, Nhyira, why is the negative added to retain earnings? I thought it's presented as a separate line item in the statement of financial position. No, it is added to retain earnings. It cannot be presented as a separate line item. It is included in retain earnings because it doesn't change subsequently. It doesn't have any effect of changing subsequently. So we bring it in the statement of financial position. Okay, so I hope you've seen the question. It's been posted on the page. Sorry, it's a lot of questions. I need to show you where the heck we are going to solve. It's a 26-page question, a lot of questions there. We are looking at gold, question 5. Gold, question 5 on page 10. Gold, question 5 on page 10. I want you to stay with me carefully because of the nature of this question. Yeah, it is also simple. You're just doing P&L here. But like I said, my focus here on this masterclass is the fundamentals, okay? Dealing with the fundamentals at the end of the day. If we're able to deal with the fundamentals, we are good there. I hope everybody is back, I guess, because some people jump over. Okay, let's go. The requirement here is pretty simple. It says we should calculate goodwill at acquisition. Fine. Then we should prepare the consolidated statement of profit or loss. Okay, so we are not doing position here. We are just doing profit or loss. That is why the examiner will ask us to do goodwill at acquisition. So let's go. On 1st January 20x2, on 1st January 20x2, Gold acquired 90% of the $60 million $1 equity shares in of silver. So stay with me carefully to see what is going on here. So what is our year ended? Be careful as always. Our year ended is 30th September 20x2. Okay. Date of acquisition, 1st January 20x2. Okay. So let's see gold and silver. So we are looking at gold group. We are starting with the workings as always. Workings 1, we want to get our group structure. So gold limited, that's our parent. Definitely gold is higher than silver. So silver limited become a subsidiary. And we are acquiring 90% of them. And so our non-controlling interest, 10%. We are always excited about the date of acquisition because a lot of things can go down there. So date of acquisition, 1st Jan, X2. Our reporting date, 30th September, X2. Remember that? Our reporting date is X2 as well. So our post-acquisition period here is how many months? 9 months. Very, very important. So January to September, 9 months. Okay. If it is 9 months, it means my profit or loss account of silver, when I'm picking anything from silver, for consolidation purposes, I'm going to do what? 9 over 12. Does that make sense? Do 9 over 12. Let's see what's happening. Gold issued 3 new shares in exchange for every 5 shares it acquired. Okay. So that is fair value of consideration transfer situation coming up for me. And so that is the first aspect of the question where the examiner said I should calculate, or we should calculate, goodwill. So working to fair value of consideration transferred. Slashing our currency sign, share exchange. So that is 90% of 16 million shares we acquired. Be careful, it is 16 million $1 equity shares. Assuming it was 0.5 or 0.7, they would have divided like the way we did in the case of Polestar and South Star. But in this case, it's a $1, so we keep it like that. So 90% of the 16,000 gives us the number of shares that we acquired. Now, in the share exchange deal, we are giving them 3 new for every 5. 3 new for every 5. That is very, very important. So that's going to be 3 over 5. 3 over 5. Now, remember I told you that in share exchange, we use the share price of the parent entity. Why? Because it is the parent issuing the shares. It is the parent issuing the shares. The question is on page 10 of the document that was posted on the page. Page 10. So that is what we get so far. Let's continue to read. Additionally, listen carefully. Additionally, Gold will pay further consideration on 31st December 20x2. Okay. Of 2.42 per share acquired. So that is what? Deferred consideration. And that will be accounted for as per IAS 38. We discount it into present terms and we unwind for finance costs. So stay with me. They said we will pay 2.42 a further for per share we acquired. So 90% of the 16,000 gives us the number of shares we acquired times 2.42 gives us the value, but we have to discount it into present terms. That is a year from now. So we have been given the cost of capital per annum to be 10%, and the discount factor at 10% for 1 year is 0.9091. And if you do the workings, it's the same, 1/1 plus R exponent n. It will give you the same answer. So 0.9091. So times 0.9091. So that is how we look at the present value. So we discount that payment into present value to get our figure coming in. Remember, on subsequent measurement, we're going to unwind, and we're going to explain the unwinding in a moment for you as well. So 0.9 by 16,000 by 2.42 by 0.9091, and I'm getting an amount of 31,680 approximately. 31,680. We are going to unwind that to calculate finance costs in the P&L accounts. And I'll explain that to you in a moment. But that is what we do there. At the date of acquisition, shares in gold and silver had a fair value of $8 and $3.5 respectively. Remember that gold is making a share exchange. So we need a share price of gold, which in this case is $8, so that we can get a fair value of the share exchange. So 0.9 times 16,000 times 3/5. And that gives me an amount of times 8, 69, 120. So that is the value of the share exchange. And these are what we can do from the preamble. Any questions, please?
Nhyira, please, can you
Any?
come over the 3/5?
In the question, we are told that gold issues 3 new shares in exchange for every 5 acquired. 3
Okay,
new for every 5. Now, so in order for me not to be taken by surprise relating to the finance cost situation, what I would do is that I'll go to my workings tray and build up finance cost so that the unwinding will be dealt with separately. Because when I say, oh, when I get to the consolidated profit or loss, I'll bring it, I may forget. So let's bring the finance cost and adjust it. So if we look at the finance cost, we realize that we are getting an amount of 672. There is no finance cost for silver. So we just bring gold's finance cost, 672. Then we bring the unwinding of the deferred consideration. Deferred consideration. And that is going to be the present value times the cost of capital times the post-acquisition period. So 31,680 times the 10% times 9/12. Remember the post-acquisition period is 9/12. So 31,680 times 0.1 times 9/12. And that gives me an amount of 2376. So that will go to finance cost in the P&L. I don't want to forget. 2376. Now, assuming we were doing statement of financial position, stay with me carefully. Assuming we were doing statement of financial position, we would have done the carrying amount of the deferred consideration because that will go to the statement of financial position under current liability. But we are not doing that. But assuming we're doing statement of financial position anchor, this 2376 will be added to the present value so that you get a carrying amount that will go to statement of financial position. Like I said, we are not doing that. We are not doing position, so there is no need to do that. Okay, there's no need to do that, but I'm doing that just for illustrative purposes. Statement of financial position, that will be under current liability. For the deferred consideration, you bring in the present value that we had from workings 2, the 3160,680. Then we'll bring in the finance cost that we had in workings 3. And that will be 2376. Like I said, we don't need this here. Plus 31,680. And that will be 34 and 56. You don't want to do a workings you are not called to do. This is for financial position, so we don't do it in the context of this question. But assuming we're doing statement of financial position anchor, this is how we will do it. Now, why do we take it under current liability? Because the payment will be done in 3 months from the payment will be done in December, and we are now in September. So it's just 3 months from now. That is why it will be classified under current liability. If it is more than 12 months, then we'll take it under non-current liability. Any questions, please? Any questions? Any questions? Okay. So let's proceed. The next thing that we need to look out for. What do I have? Yes, James.
Sir, assuming they say that the both consideration, the deferred consideration, essence of sales were not recorded. They didn't record it.
The issue about, they have not mentioned anything about deferred consideration. Definitely always deferred consideration is not included in the financial statement of the company. If there is anything, it is the share exchange that the examiner will clarify for you whether they have not recorded or not. If they have not recorded, the amount has to be splitted and recorded in the share capital of the entity. And that will be based on the nominal value as against the fair value. In this question, you don't have nominal value. So whatever value you had, that 69,120 will be splitted between the share capital and share premium at the end of the day, where the share capital, the nominal value will go there, and then the profit, that which is the balancing figure, will go to share premium. So that is how the split would have been done. And in that case, that share capital will be added to the stated capital given in the question. So the stated capital figure will go up. Then the share premium will be represented on the face of the statement of financial position.
So thank you.
Right. So that is it from the preamble, the things we can do. Let's continue. Footnote 1. At October 20X1, the retained earnings were 56 million. At October 20X1, the retained earnings were 56 million. Now, when is October 20X1? That is the beginning of the year. So what is the examiner setting me up to do for my goodwill calculation? It appears we are done with the fair value of consideration transferred. So we can get that figure coming up, 69,120 plus 31,680. I'm getting 100, 800. So I can do workings for goodwill. Definitely at acquisition. Slashing our currency signs coming up. So fair value of consideration transferred. That was from workings 2. We got a total amount 100, 800. So that is going to be brought. Then we need fair value of NCI. So far, we don't know how NCI is supposed to be valued. We're going to leave it blank, open like that. Then I'm going to bring fair value of the business. We're going to leave it blank, open like that, so that I can bring in the net assets at acquisition. So with the net asset at acquisition, I'm going to be bringing in definitely their equity shares. Now, if you remember, the equity shares has been given to us in the preamble of the question as $16 million, $1. So their share capital is 16 million. Then we have retained earnings brought forward. So we bring it in. That was 56,000. The amount given to us in the footnote, if you remember the note 1, 56,000. But this is where the journey becomes interesting. Listen carefully. We have acquired them only 9 months. It means they have been in business 3 months for the year before we acquired them. For that reason, this profit must be added to the retained earnings. So pre-acquisition profit is going to come for the year. Pre-acquisition profit for the year. And that's going to be 3/12 because they have been in business for 3 months before we came, times the profit they made for the year, 99.20. So let's get a figure coming in. 3/12 times 99.20. And I'm getting 2480. Any questions, please? I hope you are following. So that is the retained earnings situation. That's the retained earnings situation. Then we proceed. Note 2. At the date of acquisition, The fair value of silver's net assets were equal to their carrying amount, with the exception of two items. Stay with me carefully. An item of plant had a fair value of 2.6 million above. So fair value above. Please, the fact that it is above doesn't mean you add, because sometimes the examiner can swipe the fair value and the carrying amount. So the examiner can say an item of plant had a carrying amount of 2.6 above the fair value. In that case, that will be deducted. Okay, so it's not that when you hear above, no, you go and jump and go and add. You have to look at what is being above and what is being below. So be careful. Be careful. So if the question had read an item of plant had a carrying amount of 2.6 above its fair value, that means they would have carry the asset above its fair value. So they had overcharged the asset. So in that case, we will come and what? Deduct. In this case, we will add because the fair value is greater than the carrying amount. I hope that makes sense. So don't establish a rule that, hey, I saw above in the previous question, polyester, we added. Here also, I saw above, we added. So everywhere I see above, we added. Please, you will get it wrong. Make sure you understand the grammar on the position of the fair value and the carrying amount. So I go to my net asset at acquisition. That's fair value adjustment. And we bring in the first item we have there, and that is the plant, 2.6 million. Ish. 2.6 million. Okay. The remaining life of the plant at the date of acquisition was 3 years. Depreciation is charged to cost of sales. So quickly, it means we have to do workings for cost of sales. So let's go to workings 5 and go do workings for cost of sales. So with cost of sales, remember, anything in the P&L account, we will pick 9/12 of the subsidiary, silver. So cost of sales, 81,910 slash in our currency signs, code 81,9, I think 20 I saw. Yeah, 920, then 41,600. Silver is 41,600. We multiply that by 9/12. Let's see the figure we get. 41,600 times 9/12. I'm getting 31,200. Then we bring in the fair value adjustment, depreciation coming up. So depreciation of plants. And that is 2,600. Now the asset had a remaining life of what? 3 years. So divided by 3. And our post-acquisition period is 9 months. So that would be 9/12. So you work it out to get your figure coming in for the period under review. 9/12 times 2,600 over 3. And I'm getting 650. And that is added to cost of sales. Now, if we're doing statement of financial position, you know what we would have done already. Okay. You would have subtracted the 650 from the 2,600 so that the balancing figure will be added to PPE on the face of the statement of financial position. And that will be the deal there. So that is that note there. That is that first note under the fair value adjustment. That's that note under the fair value adjustment. Second note. Silver Co. had a contingent liability, which gold estimate to have a fair value of 850,000. Stay with me carefully. They had a contingent liability. This has not changed as at the end of the year. Silverco has not incorporated these fair value changes. Now, that is contingent liability. If you remember when we were explaining, we mentioned this. So that will be under my net assets at acquisition, contingent liability. Now, liabilities reduces net assets. So 850, that will be brought there as a negative. Assuming we're preparing statement of financial position, that 850 will go on the face of the statement of financial position under non-current liability or current liability because we don't know when it is due. Okay, we don't know when it is due because the figure 2 has not changed during the year. Does that make sense? Any questions, please? That is the second footnote. That is the second footnote. Note 3. Gold's policy is to value non-controlling interest at fair value at the date of acquisition. For this purpose, the silver's share price at that date can be deemed to be representative of the fair value of the shares held by non-controlling interest. Okay, so we are valuing non-controlling interest at fair value. So I go to my goodwill schedule. I write down a schedule for goodwill. Yeah, I have NCI already here. Now they own 10% of 16,000 because remember from the group structure, we own 90. So NCI is 10%, 16,000, the equity capital for the company, the number of shares they had is 16,000. Then we go and look for the share price of silver, and that is 3.5. Remember the 8 is for gold. So times 3.5. So let's get our figure coming in 0.1 by 6,000, no, by 16,000 by 3.5. And I'm getting 5,600 for the NCI situation. So we can close up the account 100, 800, and that is 106,400 in the period under review. 106,400. Let's continue to read. We don't know if there is any other thing that we would have to consider in the net asset situation, but at acquisition there, once you are finished dealing with fair value at the date of acquisition, that is all. It's hardly that something else will happen, but let's continue to read. Sales from gold to silver. Who is selling? Gold. So sales for gold, the parent, to silver in the post-acquisition period had consistently been 600 per month. Had consistently be 600 per month. Had consistently be 600 per month. Remember the deal is they have done 9 months so far. They have done 9 months so far. So the total sales must be canceled from revenue and from cost of sales. So I have cost of sales somewhere. So intra-group sales. So intra-group sales, that is 600 times 9. That's 5,400. That same figure will be deducted from revenue. We don't have workings for that. So let's bring it up. Working 6, revenue. Slashing our currency sign. Bring in the figure for gold, revenue, 103,360. We bring in the figure for silver. Remember, we take 9/12 of silver's cost of sales, 41,600. So 9/12 of that figure.
So still so not listed.
Sorry, 6,800. So 9/12 of that. That is 45,600. Then the intra-group sales situation. From workings 5, if you remember, we said we are bringing in an amount of 5,400 coming in. And we deduct. So that is the first thing you do. You cancel the total sales. You cancel the total sales. Then you continue to read if there is any provision for unrealized profit situation. Gold Co. made a markup on cost of 25% on these sales. Silver Co. had 1.2 million of these goods in inventory as at 30th September. So provision for unrealized profit, we can simply work on that and bring it under cost of sales because it's supposed to be added. So provision for unrealized profit. It is 1.2 they have in stock. It is markup, but we have selling price. So we will do 25 over 125 times 1,200. You can use the KG2 approach also, whichever swag you are up for. And that is 240. We add it to cost of sales. Assuming we are preparing statement of financial position, because the parent is the one selling, we would have deducted it from group retained earnings. Assuming we are preparing statement of financial position, we would have deducted this from group retained earnings because the parent is the one selling. Then when you go to statement of financial position, this will also be deducted from current asset or from inventory. You know the treatment already. So that is also the intra-group trading for the note 4. Any questions? Note 5. Gold Co's investment income in a dividend received, is a dividend received from its investment in a 40% owned associate it has held for several years. Now, I told you something. So investment income, the investment income here. The investment income here. It's 800, okay? But we don't bring dividend received from associate on our consolidated financial statement. Instead, it is the share of profit that we bring. So we are going to remove that out from our workings. Then we are told we own 40%. The associate made a profit of 3.3 million for the year ended 30th September. So we won't do any workings for this since we are not doing statement of financial position. We won't do any workings for it. So all we can do is maybe we can go and amend our group structure with an associate situation, 40% coming in that case, and then we get our answer coming up in that regard. So we will do the workings on the face of the financial statement. So there is no need for us to do any workings for this note. We will do it later on and deal with it at the end of the day. So that is the note 5. But note, like I said, this 800 will not be anywhere on the face of the consolidated statement of profit or loss. It will not be there. It will not be there. Note 5 is about your favorite standard, IFRS 9. If it is not your favorite, I don't know which one is your favorite financial instrument. On 1st October 20, X1, Gold Co. issued a convertible loan note. If you remember from IFRS 9, issue of convertible loan note must be splitted into what? Debt and equity, because it is a compound financial instrument. It's a compound financial instrument. At par value with interest payable annually in arrears over 5 years. The equivalent rate for non-convertible loan notes was at 8%. Now that's the effective rate. Goldco has recorded the loan notes as a liability at par and charged the annual 6% interest to finance costs. Again, stay with me carefully because something is about to go down. Included in their finance costs, this 675, which we dealt with, that figure there is the 6%, the coupon rate. But if you remember our discussion under financial instrument, it is not the coupon rate that comes to the P&L. It is the effective rate that comes to the P&L. Let's take that again. It is not the coupon rate that comes to the P&L. It is the effective rate that comes to the P&L. It means they have understated interest that is supposed to be charged in terms of the debt. But first, we got to split the debt between capital, the loan itself, and then the equity component at the end of the day so that we see what we can do here. So let's go to the next workings. And I'll be working 7. Convertible loan notes. So we can bring in our cash flow coming in, or we can start with period situation. Bring in our cash flow, bring in the discount factor, and get our present value. Make sure you write those things in full. The discount factor is always the effective rate, interest rate of similar bonds without conversion right. That's 8%. Now, so we're going to be looking at it. It says the loan is issued at par value. We are not told how it is redeemed, but then it means we will assume it to be redeemed at par at the end of the 5th year. So we bring in the interest. So from year 1 to year 5, we're going to have the interest coming in. So the interest is going to be 6% of the fair value for the period under review. Again, if you remember, it says it issued $100,000, $100, 6% loan. $100,000, $100, 6% loan. So I could first decide to get a fair value of the convertible loan note. Of the convertible loan notes. And that is 100,000 times $100. And that is going to give us an amount of, you just add, that is 5 zeros. So going to have 10 million. Here. Now, since we are working 3 zeros up, it means it's going to be 10,000. So our interest expenses will be 10,000 times the coupon rate of 6%. And that is going to be 600 every year. Then in the 5th year, the person gets back the redemption or the principal, which is the amount of 10,000. Okay. So we are giving discount factors here. You can see we are giving both present value. You see the examiner, he has given you for both the 6% and 8%, but we won't use the 6%. We have to use the 8%. So we use the 8% annuity factor for the interest because it's the same amount over 5 years, 3.3 or 3.99. Then we use the present value for the 8% in 5 years' time, 0.681. Then we multiply up. So 600 times 9.33993, sorry. And that gives me an amount of 2396. Then 10,000. Oh, I could do that 681. 6810. So that gives us the debt component for the period under review. So the liability is going to be 2396 plus 6810, getting 9260 or 9206. The balancing figure from the 10,000 becomes the equity component. In this place, we don't need it for anything. All we are interested in is the liability because we are doing P&L. So the balancing figure is the equity component. Any questions, please? And that is 794. In the context of this question, we're not going to use the equity for anything, but assuming we are preparing statement of financial position, this will go into the statement of financial position under equity as other components of equity, but we won't use it in the context of this question because we are doing just P&L, and this doesn't have any impact on the P&L. It's the liability that has impact on the P&L. So that is the split. Yes, George.
So can you please go over the discount factor, the annuity factors? I'm a bit confused.
Confused about what? Our rate.
The annuity discount factors, yes.
We discount the cash flows using the effective rate or interest rate of similar bonds without conversion right. So the reason we use the annuity factor for the interest is because the same money will be received over 5 years. So if the same money is received over a definite period of time, we use annuity factor. If the same money will be received in perpetuity, that is where we use the what is the name of this thing? Okay, so the same money will be received over a definite number of years, so we use the annuity factor. But then the principal will be received in 5 years' time, and so we use the discount factor in 5 years' time. So you don't use the 6% because we don't use the coupon rates to discount. We use the effective rate or the interest rate of similar bonds without conversion right. Interest rate of similar bonds without conversion right.
Is right?
Yeah.
Yeah, but I think if you don't want yourself trouble, you can use the discount factor for the 5 years.
Where?
I'm talking about
Which one?
yeah, you can. I say if maybe the calculation if you don't want, no, the 8% for 0.68. You can use it 5% and you still get the same answer.
You can use it for on what figure?
No, I'm saying that maybe if you don't maybe you don't understand.
You are not comfortable with the annuity.
Yeah. With the
then
annuity,
that one you will do it one after the other.
Yeah, for
the 5 years.
Yes.
Yeah, that is important. Yes. So exponent 1, exponent 2, exponent 3, exponent 4, exponent 5. Then you do for each of the years, you will still get your answer. Because when you add the discount factor for each of the 5 years, you get an annuity factor of 3.993. That is why the annuity factor is used there at the end of the day. That is the annuity factor at the end of the day. So the debt component, we must deal with the P&L account. Now, I'm going to pretend as though we are doing financial position and do some working situation on that. So assuming we are doing the statement of financial position. Yes, James.
Sir, please, if you can throw more light, it's not in the question, but assuming we were going to redeem the bond in 5 years at premium, what would have been the interest?
At a premium, the last year will be increased by whatever premium we are going to redeem it at. The final year will be increased by whatever premium figure we are redeeming it at. So if it is redeemed at a premium of 10%, then the final year, the figure will be 11,000 for you to get your values coming in.
Will you calculate it or you just add it to the 10,000? You just add it.
Yeah, you add it. Whatever premium it is. If it is premium, if it is, like I said, if it is 10% premium, then 10% of 10,000 is going to be 11,000. So that means your fifth year has to be 11,000.
Okay. Thank you.
Right. So on the face of the statement of financial position, we need to get a carrying amount of the liability using the amortized cost. So what we do is to bring in the initial value, which we got here, 9260 or 9206, okay? Then we bring in the interest. The interest is going to be 9206 times our effective rate of 8%. So 0.08 times 9206, and that is 736. 736. Then we bring in the interest payment, and that'll be based on the coupon rate. And that was 6% times the 10,000. And that's 600 will be less. So this becomes the carrying amount, 9206 plus 736 minus 600. That'll be 9342. You don't need this in the context of this question, but assuming we were doing statement of financial position, this will go under non-current what? Liability as the carrying amount of 6% convertible loan note. If we're doing statement of financial position. In this question, we are not doing statement of financial position, so it's not needed, okay? We are just doing P&L. So because we are just doing P&L, our concern will be the amount that has to be charged into the P&L. So interest charged to P&L. Now, I told you that the interest charged to the P&L is always going to be the issue relating to, how do we call it? The effective rate. The effective rate. But if you look at this question, so interest at the effective rate, that's 736. Then the interest at coupon rate, which they have charged for the year, is 600. So it means there is an excess amount that we have to bring in at the end of the day. So additional interest to be recognized in the P&L will be 136. Will be 136. That is additional interest. And so that is the figure we take to our finance cost. We did finance cost somewhere. What the heck is that? Okay, this is it. So we'll charge convertible loan notes, an additional figure of 136. Any question, please? On convertible loan notes. The excess amount, 136. That is from Workings 7. The excess amount, 136. Any questions, please? Any questions? They have already charged based on the context of the question, they have already charged the amount. So it says, Goldco has recorded the loan interest as a liability at par value and charged the annual 6% to finance cost. So that is why we know they have already charged the 600. So since they have already charged the 600, then we need to add the additional of 136. We need to add the additional of 136. So that is the issue there. Any questions, please? At 31st, yes,
Nhyira?
Oxbet, yes.
Yeah, so please, can you just ignore the workings you did here and then you take it out, you take the finance cost out and just bring the interest, the effective interest calculations. Like the
Which workings? This one?
You just send the 736 to the finance cost and then you take out the 600. No, not
You
that
mean,
one. I'm talking about the interest charge. to profit.
Okay, here.
No.
This one.
Yes.
Okay. Okay. So you are saying that we rather go and add the 736
Yes,
and then
take out,
subtract the 600. Yeah,
yes.
it will be the same effect. It
So
will be
that
the
you will
same
not do
effect.
these workings.
Yeah, once your brain can process that, no problem. So it depends on the wavelength your brain is at. So once your brain can process that, I need to deduct and add the whole amount, fine, you will be good.
Okay.
Oh, now I'm seeing a comment coming in on YouTube. Let me see. Abekwe Mr. Hi, Nhyira. I need not comment, but I want your students to know they are the right place. I won't forget how you helped me to qualify CA. Thanks. Good night. Oh, okay. Abeku, thank you. Good night. Yes, Madam Josephina. Umbana kachro mose adeasa omonda na adeasa. Yes, please come up, Josephine.
I'm not asking any questions, sir.
Oh, okay, Matty.
So,
yes.
So please, if you can you give me the annuity formula if you have?
You
the
can
formula.
get annuity. No. I don't have that off head now.
Okay.
Yeah.
Yeah, thank you.
Right. So
after closing, if you need me after closing, I'll give to you.
Okay. So at 30th September 20 X2, no impairment to goodwill is required. Profit accrued evenly throughout the year, unless it's the same thing. We know it's it's accrued evenly. No. Accra. Yeah, let's go and finish our goodwill. Let's add up here to finish our goodwill. So you see how simple the question is. But most importantly, my take on this question is the finance cost on the convertible loan note, and then the deferred consideration, the issue about that in calculating a fair value of consideration transferred. So 16,000 plus 56,000 plus 2480 plus 2,600 minus 850. Boom. I'm getting 76,230. Make sure you confirm that for us. 76,230. Then definitely here we'll get goodwill at acquisition. No, okay. Minus 106,400, and that is 3170 for our goodwill. 3170. Please note, if there was impairment in goodwill, don't come and subtract it and get goodwill at the reporting date. The examiner didn't ask you goodwill at reporting. So just end here. Thank you very much. We will clap for you and we will let you go away. If there is impairment in goodwill, don't bring it here. Go and add it to either the cost of sales or add it to administrative expenses. Period. If you're in the P&L. If you're in the P&L. If you are in the P&L. Yo. So that's the A aspect.
Inside, because this one is because of is a goodwill at acquisition.
Right.
So if it's at reporting, then maybe what you
then
are saying.
If there is impairment in goodwill, we'll bring it up.
Okay, thank you.
Okay. So that's our goodwill, the A aspect of the question. We got that covered cleanly. Let's close up certain things. Cost of sales is more or less like we are done. So let's add up cost of sales as well to see what we have for cost of sales. Nothing else is going to come here. But there is a workings we've not done. Who knows the workings we need that we have not done? 31,200, 650, 5,400, 240. And that is an amount of 108,610. 108,610. There is a workings we need for the P&L accounts, but we've not done it.
A group retained earnings.
A liar has a tail. P&L, you don't need group retained earnings. Maybe NCI reporting date. How they going? How they heading? Maybe we don't need that because we are doing just P&L. So we don't need NCI reporting. Yes. What do you think we need that we've not done? Post-acquisition profits or loss. Post-acquisition profit or loss. So we could do that here on Workings 8 situation coming up there. Post-acquisition profit or loss. This company, they made a profit. Let's go pick their profit. Remember, it's operation 9 months, right? So 9/12 situation will come up there. Then we get their figure coming in for the period under review. So let's see, 9920. Okay, so profit for the year. Make sure you remember you're dealing with 9/12 times 9920. Let's pick it up. 9/12 times 9920. That is 7,440. Now, there were some fair value adjustment situations that we would have to take into consideration based on what we have at the end of the day. And if you remember, it was depreciation that we brought in the cost of sales. Okay, the fair value adjustment depreciation, the 650. So we need to come and deduct it from here. So fair value adjustment depreciation from Workings, Workings 5, 650. That was the only thing, period. This is the post-acquisition profit minus 650. And that gives us 6790. The reason why we need this is we need NCI share. So NCI share of this will be 10% of 6790. And that will be 679. Because that will be in the P&L accounts. That will be in the P&L accounts. And we are done. Very sweet, simple, straight to the point. So let's extract the P&L. And that'll be all. So gold group. Consolidated profit or loss. For the year ended.
Nhyira,
30th.
please, the PUP is not affecting the post-acquisition profit.
Who is selling?
Okay.
The parent was the one selling. The parent was the one selling. If it was a subsidiary, then it will come. So we go revenue. We did Workings for that. Let's go pick the absolute figure from Workings 6. 143,560. 143,560. Workings 3. 143,560. We bring in cost of sales. We did a Workings for that also. 108,610 from Workings 5. 108,610. Subtract that beautifully. 143,560 minus 108,610. Boom. 34,950. And that is gross profit. Then we bring in the other inconveniences we have in the question. The other inconveniences are distribution cost. So we bring it up. So distribution cost. And we have our parent entity coming in as 2560. So we bring that up, 2560 plus 2980. 2980 times 9 over 12. Because remember, anything of the subsidiary, we pick that. So 9 divided by 12 times 2980 plus 2650. Boom. I'm getting 48550. Who is coming up? Okay. So 9 over 12 times 2980 plus 2560, 4795 instead. Make sure you are confirming my figure. So it's an Digwa. Administration expenses. So admin expenses. We bring in the situations, 60 and 80 plus the subsidiary, 3740 times 9 over 12. 9 over 12 times 3740 plus 6080, and that is 885. We subtract it. Next item is investment income. I told you we won't bring that. Instead, we will bring what? Share of profit from the associate. So share of associate profit. If you remember, it was 40% of something. Go back to the notes. This one, the note 5. I told you we'll deal with it on the footnote. So we'll take 40% of the 3 million. So 0.4 times 3,000. That's 1,200. We bring that up. Then the next item there is finance cost. We did the workings for that. So we go pick it up. Finance cost. Oh, we didn't add that up. Let's add it up. 672 plus 2376 plus 136. I'm getting 3184. So that is workings 3. We bring it up. 3184. That's finance cost to be deducted. From there we go to profit before tax. So let's work it out. Profit before tax. So let's do the arithmetics. 34,950 minus 4,795 minus 8,885 plus 1,200 minus 3,184. Boom. 222 something something something. 34,950 minus 4,795 minus 8,885 plus 1,200 minus 3,134. 19,286. Please make sure you confirm the figures as well. 19,286. Then the next item is income.
Can we take the admin expenses?
The admin expense.
Yes, for silver.
What was the figure?
I want to
It's
check from
2980. Okay, sorry. Admin 3740. That's what we are bringing. 3740.
Okay, thank you.
Right. So income tax expense. income tax expense. I'm going to slash that up. Let's see, 12,928. $12,928 plus. Now here you will add, because it is a tax they are all paying. Okay. You realize in the first question we solved, we subtracted because somebody was having positive in the tax portion, but here it's negative. So 2560, no P. So you add 9/12, 2560. So let's get the figures coming up. 9/12, 2560 plus 12,928. And I'm getting 14. No, relax. My tax is 4480 rather. I was picking the profit for the year. 4480.
So what do you
4480. So 4480. 9/12 times 2560 plus 4480. That's 6,400. You subtract it, and boom, that gives you the profit for the year. Profit for the year. So minus 19,286, getting 12,886. You are not done. So you share profit attributable to the equity shareholders. That's going to be the balancing figure. We know our total profit for the year is the figure we just had, 12,886. Then we bring in the non-controlling interest. We did workings for their share. If you remember, from the post-acquisition profit is workings 8,679. Here, it is an addition. The company didn't make a loss, so you don't negate it. It's positive. So you subtract 12,886 minus 679. And that is 12,207. That is the answer to this question. Any questions, please? Yes.
Can I see the NCI?
Can you what?
Can I see the working for the NCI?
Workings 8. This is it.
Thank you.
Okay. All right. Yes. Yes.
Assuming there was a trading activity within the associate, is it also going to be treated as a subsidiary?
Any trading within the associate, we take our portion of the post-acquisition profit. So if the post-acquisition, provision for unrealized profit is whatever, 20,000, we would take only our share of the ownership we have in the NCI. If it is 40%, 40% of that PUP. That is what will be accounted for if there is any trading activity between the parent and the subsidiary, the parent and the associate.
Okay.
Okay. Any other questions for me, please? So that is what we mean by the basic issues generally when it comes to dealing with consolidated financial statements. Sir, please, I would like to snap the pics of the first question we solved. My network went off during the Huawei. Okay, let me see. Where is it? What's the name of our question again? Let's see. Polyester. Okay, so it starts from here. Let's start from here. Okay, so I think that is it about that. And this is what we want to do with you. I don't know. I'm contemplating whether we can do more of these sessions. Maybe we can dedicate another time in the course of the week. It could be Tuesday night. We could do like 10 p.m. to around 1 a.m. or 2 a.m. to around 5 a.m., something like that. I'm thinking about it. Whether it's something feasible that we can do and whether people will be able to jump on the call with us. I don't know. Next slide.
Hello, Nhyira.
Yes.
Please, do we have class this week?
Did we have class this week?
Do we have class for this week?
Yeah, from the timetable, there is class.
Oh, okay.
Yeah. Mary said what? Says, suppose we solve an OCI profit of 2,000. How do we calculate the distribution of that profit to the shareholders and NCI? Whatever total comprehensive income you get, you just take the NCI share of the total comprehensive income. Then the balancing figure will become the shareholders of the parent company. So if we have total comprehensive income, you bring the NCI, you take the percentage of NCI ownership of the total comprehensive income, and then the balancing figure of the total comprehensive income is what will go to the equity shareholders. It's what goes to the equity shareholders. Let me know if that makes sense for you. Next page. Next page. I didn't get it. Whatever total comprehensive income you get, like your scenario, you said 2,000. So you share that 2,000. NCI, you bring NCI percentage of that 2,000. Whatever figure you get, the balancing figure will become how much will be given to the equity shareholders. That is the treatment. That's how you share the total comprehensive income. All right, that's fine. So this is the page on David. Next one, current assets. Next one, non-controlling interest and group retained earnings. Next one, the financial statements. And then the position. Okay, so that is it about that. Like I said, we will see if it's possible to have some sessions like this extensively. I mean, some of you, your concentration level has reduced since we started with the second question. What does our honest but we move. You can go and watch the playback and take care of yourself.
Nhyira,
Yes.
please, will you post it on the page
Yeah, it'll be available on the portal.
now?
Yeah, as soon as we are able to upload. So it should be there. Maybe if we have a good network, it should be there within the shortest possible time. Rose, you wanted to come up or you are good?
No, I'm not. I wanted you to show me the slide on the finance cost, the working for the finance cost. How we got it 136.
Okay, let me bring up my screen. When we count him. He will run the risk when we undo him. So finance cost, okay. So this is where gold is starting. This is the finance cost we're considering. I think so. I'm coming.
How did
Gold.
we get it? Okay. How did we
I'm
get
coming.
that?
Yeah, I'm coming. So gold. Someone said he was taking picture of gold. So gold. This is the first page. Then this is the second page. Yeah, Rose, please ask your question.
Asking how did we get it 36? If you want 36, I wanted to see.
How did we get it?
Yes, yes.
Okay, we calculated for it here. Here. You saw that the interest charge for the year based on the coupon rate is 7.36. But the entity charged based on the effective rate is 7.36. But the coupon rate is 600. In the question, we are told that the company had already charged the coupon rate in finance cost. So that is why we subtract and then we get a 136 as the additional interest that must be taken to P&L. Because we said in the P&L, you don't bring the coupon rate. It is rather the effective rate that you bring. Does that make sense?
Yes, yes. Thank you.
Okay. So from finance costs, you come here, goodwill. Now, this thing is not working. I forgot to tell you. Sorry about that. It's actually the A aspect of the question. This is actually an answer. This is actually an A aspect of the question. So please redo your numbering. This is an A aspect of the question. It's a requirement of the question. It's not working. So it should be a requirement instead as A aspect of the question. Then cost of sales coming up. Yes, Joseph.
Good evening.
Yeah, good evening.
Okay, so please, this one is a quick one. On the goodwill calculation, I saw 850 contingent liability and I was lost. Now, please, I want to know where that is at.
Is that?
The contingent liability 850. Yeah, at this
Yeah.
time. Yeah, I wanted to know where the figure came from.
It came from the question. It came from the question, the notes, the question here, the note 2, the second part of the note 2. Silver Co. had a contingent liability, which Gold Co. estimated to have a fair value of 850,000. So that's where it's coming from.
Oh, okay. Thank you very much.
Okay. Then you get your cost of sales coming up. Revenue adjustment. Okay. Then the convertible loan notes. Then the carrying amounts. Then the post-acquisition profit. Then the financial statements. I don't know. Next week, Sunday, you guys will be preparing for corporate reporting. Would you want us to have any session? Sorry, corporate reporting and financial reporting. Would you want us to have any Q&A session? Maybe
Yes,
around this
yeah.
around the same time. Would you want us to have any Q&A session so that if there are any questions, anything that we've not touched on, probably we could use that time to touch on it and share our thoughts on it. Is this something that you guys will be up for?
Yes, sir.
Moon can know that. Moon can know that.
Even remember, I was even telling you that the exam we could when we had that 5 minutes of communicating.
When you enter the exam hall and you call me, it won't come. Nobody, when you call me, it won't come. During exam hours, my phone, it won't come.
Yeah,
Flight
we are
mode.
Now we are representing you. We have to honor you for your effort.
Okay.
We will use Africa Electronics.
Sure. I don't communicate through Africa Electronics.
You know that one is saying, that one you can go to London right now without playing.
Okay, so we're gonna. I'm gonna see if it is something you guys will be up for, will be excited about. Like I said, I'm gonna see. I have to just monitor myself a little bit because throughout this week, like it was really hot for me. It was really intense. I mean, the number of classes that we need to have and arranging myself. So I'm gonna see if it is possible for me, health-wise, psychologically wise. We could have some dawn sessions, like I was saying, late nights. You know, if you are from work, you guys are tired, your brain will not be working well. So probably we could do some dawn. You sleep a little bit, then 2 a.m. ish. We can do some things, but certainly next week, Sunday, we will meet for some Q&A so that any other thing that we may not have shared our thoughts on, we can trash through it during that time as you do your revision, and it will be good there. Then also what's going to be happening is that I will be having some Q&A sessions for each paper going on in the subsequent day. So after Monday, Tuesday, I think management accounting and advanced taxation also. So Monday evening-ish, I'll be having some Q&A session relating to those subjects. And I'm hoping that we can do that throughout so that as you do your revision, I could work with you on your revision and then deal with the issues that has to be dealt with and discussed better throughout the week as you write your exams in that regard, if that is possible for us, and if we will get people to jump on the call on that. So that's it about that. It's been a long time.
Then you mean that tomorrow evening there's no PSA?
No, we will do PSA tomorrow evening.
Okay.
Hey, we will do PSA. Every class in the week will be available. Every class in the week is going to be taken. So tomorrow we'll do PSA. So that's it about that. Enjoy yourself, go and sleep, and make sure you don't go to work tomorrow sleeping. All right.
Good night.
Okay. Bye-bye.
And the second week. Bye.